All right, so we know the market came out a little bit sluggish, but guess what? According to Blue Curtic, this is not unusual for day three of a Santa Claus rally that begins with a 0.3% move. So maybe we're on track and the rest of the week will get better. Meanwhile, folks, the action beneath the surface really, I think, is a potential microcosm of what we could see in 2026, including from Friday. I think Friday, take a look at this. A lot of profit taking, right? So your biggest gainers, your biggest decliners, look what they are already up for the year, though. Palantir was down Friday. Tesla was down. Robinhood up 200% for the year. So profit taking in these kind of names. Your biggest gainers are also the biggest losers. So Target, Smurfit Westrock, Deckers, Workday. And so essentially what we're talking about is a lot of people are trying to pick these names that they think are ready to bounce back, bottom fishing. You know, Benjamin Graham actually wrote about taking advantage of volatility. So you want to buy these stocks, and he considered this sort of a margin of safety, which means that, you know, if they're deeply discounted to intrinsic value, it's worth to buy. But it's not foolproof, right? Because also on Friday, Texas Pacific got hammered, and it's also been getting hammered all year long. So it's just a word of caution there. But considering how bifurcated this market was this year, bottom fishing isn't as simple as buying the biggest decliners also, folks. I mean, a lot of people out there looking to buy them. Now, Goldman Sachs is talking about fallen angels, technology names, right? Roblox, Visa, MasterCard, DoorDash. They say, you know what? These are names. These are household names. They were up big. They're down. Look at those areas. Another way you can do this is looking at insiders, right? Okay, if the stock is getting hammered so much, maybe the CEO is buying. Look at where you have insiders buying. Coca-Cola, Salesforce, these kind of names. Not bad to keep these sort of lists. Now, of course, the flip side of all this bottom fishing, simply chase the winners, okay? They continue to be winners. Large cap names have been winners for a long time, especially technology. And you know what? Think about this. It's interesting because we had lackluster performance in most of the Mag 7 this year, and it belies the notion that we're in a tech bubble, right? Because usually what happens in a tech bubble, it goes up, and then at the end, it really has this spectacular move to the upside. The PE ratio explodes to the upside. Well, look what's happening this year. That's not exactly a spectacular ending, right? So don't worry too much, in my opinion, on this the bubble, AI bubble. Now, one lesson I do hope everyone takes away from this year is to separate the noise from the market's message, right? The fear gauge, which dipped so much. Remember the VIX exploded so many times? Well, you know, the thing is, the VIX going at one point last week was down 5 days in a row, went below 13.5. And essentially, what does that mean? Well, historically, a year later, the market's up at least 11%, and it's worked 89% of the time. That's a pretty good sign of calm in the market right now. Of course, there are things that we should be concerned about. According to DB Deutsche Bank, they did a survey, and at the top of the list, tech valuations. You keep hearing about this. Be worried about the tech valuations and the AI enthusiasm, you know, worried about private capital crisis. And of course, you just heard Ed Yardeni say, maybe be worried about the new Fed if they run its economy too hot.